Welcome back, everybody. Amazon has been one of the best new additions to my portfolio in 2024, and their CEO, Andy Jassy, just released his annual letter to shareholders. And honestly, the big takeaway is something that should excite shareholders and people interested in adding Amazon to their portfolio. So we're going to talk about what that big takeaway was. Also, I added a new stock to my portfolio this week. It's a relatively small position, but something that I'm pretty excited about. So we'll dive into the details of what I added and why. And lastly, Jamie Dimon, the CEO of JPMorgan Chase, was in the news because of comments he made in his own shareholder letter, saying that rates could spike up to 8%, so we're going to dig into that as well. Now, my neighbors decided that they're going to work on their lawn right as I'm working on my video, so hopefully you don't hear that come across in the mic, and hopefully they'll decide to just do mine while they're at it, but I guess we'll see. But first, let's get into Amazon. Now, Andy Jassy released his letter to shareholders, and there were some interesting things that I wanted to talk about with it. Now, if you remember, I added Amazon to my portfolio in January, and it's already up close to 20% in just a few months. And what's nice is that the investor letter talks about a lot of the things that attracted me to the company in the first place. So let's walk through it. So here's the 2023 letter to shareholders from Andy Jassy, and I just highlighted some things here that were interesting to me. Now, Amazon's total revenue grew 12% year over year. Again, double-digit revenue growth is great, especially when you consider that it's $500 billion. I mean, it's just an enormous amount of money. But the real story was operating income being up 200% year over year. So it basically went from $12.2 billion to $36.9 billion in 1 year. I mean, that's just insane, to where you had an operating margin of 2.4% and now it's 6.4%. I mean, it's a little less than triple. That's just amazing change in 1 year's time. And then when you look at their free cash flow, it was obviously negative in 2022, but from negative 12 to 35 billion in 1 year. I mean, this is just insane. And it just speaks to the opportunity that Amazon has because, again, you have $500 billion of revenue. And if you can keep getting efficiencies like this, I mean, sky's the limit. And the great part about this is that they're not done improving. And he says it right here. Now, I'm going to skip over these highlighted items because these are more about just growing and retaining the retail business and all the things they're doing there, which is great, but just a little off topic. So he says it here. As we look toward 2024 and beyond, we're not done lowering our cost to serve. So what he's saying is that, look, we've made great strides in efficiency, and that drove a lot of operating income, a lot of free cash flow, and that story is going to continue. And he says it right here. We've challenged every closely held belief in our fulfillment network and reevaluated every part of it and found several areas where we believe we can lower costs even further while also delivering faster for our customers. Our inbound fulfillment architecture and resulting inventory placement are areas of focus in 2024. And we have optimism there. There's more upside for us. So what I take from that is this great story about efficiency gains in the retail segment and driving free cash flow in that business segment is just going to continue. And remember, that's just one segment. So now, if we go down to advertising, they grew advertising 24% year over year from 38 billion to 47 billion. And I've talked about this before, to where Amazon's ad network is the fastest growing one in big tech. And so what we have here is a totally different part of the business that's growing at a rapid rate and contributing to that increased operating income and free cash flow. Then if we scroll down even more, he says, shifting to AWS, we started 2023 seeing substantial cost optimization, with most companies trying to save money in an uncertain economy. Now, this is a great point because it's, look, companies spend on cloud, right? And Amazon is the market leader in that industry. But they started the year where people are trying to save money, and they worked with them with their own chips and these other things where they could try to reduce the overall cost to the customer. But then what he says is that by end of 2023, we saw cost optimization attenuating, which I probably can't say that word correctly, new deals accelerating, customers renewing at larger commitments over longer time periods, and migrations growing again. So what he's saying is, look, we started the year where people were cautious, but by the end of the year, spending picked up and people wanted to ramp up. But what I take from that story is two things. One, by end of 2023, things are ramping up again. That's good for Amazon and their cloud business. And two, anytime that their customers want to ramp down cost or want some options to be more cost efficient, they have some options that can help them so that they kind of keep that business even if it's at a lower amount. And then if we scroll down, we see that another segment of the business is Prime Video, which they believe can be a large and profitable business on its own. And we haven't talked about it much, but they just started adding ads into Prime Video, which is going to drive some revenue in that segment, either with people who want to opt out and are willing to pay the monthly fee, or the ad network growing because more ads are being shown on Prime Video. And then lastly, they talked about their low Earth orbit satellite initiative that aims to provide broadband connectivity to the 400 to 500 million households who don't have it today, as well as governments and enterprises seeking better connectivity and performance in more remote areas. And this one I wasn't as familiar with, but it sounds like a Starlink competitor. And he talks about it being a very large revenue opportunity for Amazon. And so this would be Amazon getting into a brand new industry of broadband internet where they don't really play today. So as you can see, Amazon is in a lot of different areas where they're either the market leader or have a big opportunity to gain market share. So all that is exciting stuff. And I haven't even talked about the big one yet, which is AI. And if we scroll down even more, I'm going to touch on this just a little bit, but there's a whole long piece here that talks about Amazon's view about primitive services and how they kind of run their business and how they try to innovate with this idea of primitives. And I'm not going to get into all this. You can read it if you want, because I'll put the link down in the description. But the idea here is that Amazon thinks about their business and the idea of primitives. And the best way that they kind of describe this is that a primitive service is a foundational building block that builders can weave together in whatever combination they desire. And this is the exact approach that Amazon took when they built AWS. And this is a story that a lot of people talked about, to where AWS was something that Amazon built for themselves, but they built it in a way that it could be extended to other customers in the future. And the beauty of that is not only did AWS help their core business of retail actually grow, it also gave them a whole new core business that really drove the profits for their company for a long time. Because not only was it used for their Amazon.com marketplace, but now it's used as the primary cloud provider for the internet. And so the reason why this is important, and I wanted to bring it up, is that he's saying that the next set of primitives for Amazons that they believe in are going to be generative AI. And the idea here is that Amazon's going to take the same approach that they did with AWS and how they attack generative AI, because they're going to have opportunities at the 3 different layers of the AI stack. And it starts with the bottom layer, where it says the primary primitives are the compute required to train models and generate inferences or predictions, and the software that makes it easier to build these models. And then further down it says, to date, virtually all the leading FMs have been trained on NVIDIA chips, and we continue to offer the broadest collection of NVIDIA instances of any provider. But then they go on to say supply has been scarce, cost remains high, and the idea here is that Amazon is going to continue trying to innovate on their own chips to be able to bring additional processing power and some cost options for the future depending on what their customers want. But what I also take from this is that they're going to continue buying NVIDIA chips because they're currently offering the broadest collection of NVIDIA instances of any provider today. And then for the middle layer, what Amazon's thinking is that you're going to have customers who want kind of this AI stack as a managed service. So they're not trying to build their own model. They just kind of want to use the models that already exist, but customize it with their own data, but then leverage a leading cloud provider, their security, and all their features so that they can build their own AI-based application, but have it as this packaged managed service that they get from Amazon. And basically that's Amazon's Bedrock service, which we've talked about on this channel before. And then lastly, the top layer of the stack is the application layer. And that's where Amazon is going to be using these AI tools to try to innovate in their own successful businesses already, which are things like Rufus, which is their AI-powered shopping assistant in the Amazon marketplace, as well as Alexa getting an upgrade with AI features. But as you can see, as we went through this letter, there's so many positive things happening for Amazon right now, and they're in so many places where they have huge opportunities to continue to grow, even though they're already a market leader in a lot of them. So yeah, this investor letter, in my opinion, was exciting. And part of it is I was already excited about the things that Amazon was doing, and this just kind of reinforced it. But it's things like having growing profitability in their huge retail segment, being a market-leading logistics and distribution play, being a market-leading cloud provider, being the fastest-growing ad network in tech, and seeing positive opportunities in streaming video and in satellite-based broadband services. And they plan to use their framework of building out primitives like they did with AWS for generative AI, which is chips, compute power, and software for model development at the bottom layer, middle layer services that allow access to existing models and infrastructure to build on top of them, and then at the top layer, integrating generative AI into their own large and already successful businesses like Amazon Marketplace and Alexa. And look, this is why in my last portfolio update, I said Amazon was one of my highest conviction holdings. So the big takeaway from this investor letter for me was that at even a $2 trillion market cap, Amazon's growth story is still strong. And that's both in the wide variety of opportunities they have in different industries, but also in the size of the opportunities that they have in those industries, because digital ad spend is still growing overall. Efficiencies in their retail segment still have a lot of runway to go. Cloud is still growing. Broadband internet would be a totally new market for them, and generative AI is an opportunity that we're not sure what the limits even are yet. So not only do they have a lot of different opportunities, but they also have very large opportunities. And that's why my overall confidence in Amazon's continued growth is extremely high. And this investor letter didn't do anything to sway that. If anything, it just reinforced it. So a lot of exciting stuff for Amazon, and that's why it's quickly becoming one of my favorite stocks. Okay, let's move on to what stock I added to my portfolio this week. Now, it's a stock with a great brand, a strong core business, growing free cash flow, and no debt. And that stock is Lululemon. Now, I evaluated Lulu last year when it was at around $400 per share, and I rated it extremely high in terms of business and operational performance. But I rated it as a hold mainly due to its valuation at the time. And as you may know, Lulu has dropped about 10 to 20% over the last couple weeks after their most recent earnings call, where they beat expectations but gave a weaker than expected outlook for the future. And that made me dig into them again just to see how they looked, and spoiler alert, they look better than they did last year. Now, I'm not going to go through the full analysis in this video, but here are the highlights that we're going to touch on. Their growth and growth opportunities, profitability, financial performance, product and brand strategy, and valuation. Now, obviously, Lululemon is an athleisure apparel company best known for their women's yoga pants, but they've expanded their product line and have a strong, almost cult-like following due to the quality of their products and their brand focus of bringing people together. So in terms of why I was interested in Lulu, well, let's go through the different areas. In terms of growth and growth opportunities, Lulu had double-digit growth over the past year and projected to be double-digit still over the next coming year. But their 5-year averages were over 20%, which is why some folks are worried that the growth story is slowing. But in terms of growth opportunities, not only is Lulu continuing their organic growth with their primary women's athletic wear line, they've also expanded into menswear. And they've continued their international expansion, which is actually going very well. Because last year, they grew international net revenue by 54%. And then specifically in China, the revenue was up over 78% last quarter, when many companies are starting to struggle there. So while other companies are struggling with the economy in China, apparently they're still buying Lulu. Now, in terms of profitability, Lulu has a gross margin over 55%, which is excellent. And their free cash flow margin is over 15%. And both of those are improved from their 5-year averages, which is definitely good. And this is because Lulu is primarily a direct-to-consumer company, which gives them an advantage to some of their competitors like Nike, Adidas, and Under Armour, who still get a large portion of their sales from wholesalers, which of course squeezes their margins. While Lulu's margins are a strength and mean that they can make as much profit on less revenue than their competitors. Now, in terms of their finances, Lulu has had consistent revenue growth for the past decade, with it being up every single year. And in terms of debt, when combined with their cash and equivalents, they have a negative net debt, which basically means they have no debt. Now, when it comes to their product and brand strategy, there's a lot we could talk about here, but I'm going to try to keep it brief and just focus on the thing that I really love about it, and that's Lulu wants to be the premium provider. And their whole brand is about people who want to live a healthy lifestyle, which is a growing category across the globe, especially with younger folks. And they try to quantify that premium through having top quality, technically advanced products, a strong culture, and being focused on creating positive change. So basically, they're connecting these ideals together to justify their premium. It's you're getting top quality, you're part of the Lulu family, and you're part of something bigger than yourself that's making a positive impact. What type of customer demographic is that going to hit? Well, number one, it's people who have the means to buy Lulu clothes because they're doing pretty well, and obviously that's not going to be everybody. But it's also younger folks who want to be part of something and have their products and their clothes and the things that they buy actually mean something to them. So in my opinion, they're really hitting the nail on the head here in terms of strategy and aligning with the market trends of their core demographic. And they're primarily direct to consumer, which is amazing because it gives them the ability to cultivate that image even better. Because some critics will say, well, eventually people will stop buying a $100 pair of yoga pants when they realize that they can get ones that are just as good for half the price. But that's just it. They're not just as good for people who actually buy Lulu. All right, so then lastly, let's talk about valuation. So Lulu's at about a 29 price to earnings and about a 25 projected price to earnings. And they're at a 19 price to operational cash flow and about a 20 projected price to operational cash flow. Now, looking at the 10-year trends, it looks pretty attractive, with the price to cash flow levels not being this low since about November of 2017, when Lulu was trading at a price of around $66 a share. Now, the main question here is, are the growth prospects still good enough to where a 25 projected price to earnings or a 20 projected price to operational cash flow is still warranted? And for me, the answer is definitely yes. And just to compare it to when I evaluated Lulu last year, their business was good, their operational performance was good, but their valuation was poor because they were at a 50 price to earnings and a 31 price to operational cash flow. And both of those look significantly better now as their share price has come down and their cash flow has continued to increase. So again, it's a situation where a quality company is growing the business faster than the share price, and so now it's starting to look attractive. So how would I rate Lulu today? I would still have their business as good for pretty much the same reasons. Their operational performance as well is good, and now their valuation to me would be at least okay. And overall, I think their growth prospects are so good that I was more than comfortable adding Lulu at these levels, and so that's why I did. Now, I didn't go through all the details of my research in this video, but if you want to know more about Lulu's business, I highly recommend checking out this video by this channel called The Art of Business, and the video is called Why Lululemon is Ahead of Its Time. Now, this is an amazing video. They did a great job on it, and they only have about 3 videos on their channel total, but I don't know what that's about, but this video in particular was excellent. Now, unfortunately for me, I didn't see this video till I was close to the end of my research, which sucks because it would have saved me a lot of time. But I still learned some stuff, and if you're interested in learning more about their business, I highly recommend you check it out, and I'll put the link down in the description. All right, so let's get to the last topic for today. Jamie Dimon also sent out his letter to JP Morgan shareholders, and he had some interesting things to say in there. Now, I'm not going to go through the whole letter. I'm just going to hit on the points in this article, but I'll link the full letter down in the description. So if we just hit the highlights in this article, you can see that Jamie Dimon says the market should be prepared for more turbulence than what is currently priced in. So that's already kind of an ominous start to his comments. But basically what he's saying is, equity values by most measures are at the high end of the valuation range, and credit spreads are extremely tight. These markets seem to be pricing in at a 70 to 80% chance of a soft landing, modest growth along with declining inflation and interest rates. But what he's saying is, I believe the odds are a lot lower than that, and in the meantime, there seems to be an enormous focus, too much so, on monthly inflation data. And we see that anytime the CPI data comes out, the market has wide swings up and down, and it's just kind of a crazy thing. But the main point of what he said is here. He says, therefore, we are prepared for a very broad range of interest rates from 2% to 8% or even more, with equally wide-ranging economic outcomes, from strong economic growth with moderate inflation. In this case, higher interest rates would result from higher demand for capital, to a recession with inflation, i.e. stagflation, which he calls the worst-case economic scenario would be stagflation. Now, regardless of what you think about Chase as a bank or Jamie Dimon as a CEO or as a person or whatever, in my opinion, he's an excellent bank CEO. Like, he really knows how to run a bank. And while I don't agree with everything he says or his opinions, I do in general think he's a smart guy, and I respect his point of view, even if I don't always agree. So when he says they're preparing for anything from 2% to 8% interest rates, it makes you wonder about the possibility of rising rates still, basically saying that inflation is not over and the Fed's going to have to continue raising rates, and that the worst case possibility of that would be stagflation, which is a situation where we'd have high interest rates, low economic growth, and high unemployment, which last happened in the US in the 1970s, but also for a prolonged period in Japan, leading to the lost decades of their their stock market, which finally in February of this year surpassed previous highs that they hadn't seen since 1989, so roughly 35 years ago. Now, obviously, we'll see what happens, but I wouldn't just dismiss what he's saying as some crazy person talking doom and gloom. Like, he's a pretty sharp guy, and at a minimum, we should be thinking about the possibility. And there's no doubt in my mind that JP Morgan will be preparing for that situation as a company, which is probably good news for their shareholders. Now, that's all that I have for you guys today, but what did you think about me adding Lululemon? Let me know down in the comments below. Now, if you missed my video on Amazon and want to know why I decided to add it to my portfolio in 2024, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see y'all in the next one. Peace.